Okay, I think we're going to go ahead and begin. We'll let people in as the presentation continues here. Okay, so I wanted to go ahead and I'll start off with the agenda, and then I will go into Insight Strategies, who we are and why we're holding these Q&As. We'll talk a bit about what type of clients we work with here at Insight Strategies, and then how we work directly with loan officers as well. Today, the primary focus of this case study is defaulted student loans. So we do these Q&As on a monthly basis. In the new year, we're going to be switching to doing these on a twice a month. So twice a month or every other week, just depending on the amount of topics, the amount of questions that we're getting from our partners. So our partners are loan officers and realtors primarily, and anyone who really relies on credit. We do also work with car dealerships in some cases as well. And then if time is permitting, we will also talk a bit about what impacts credit score the most, how to help borrowers understand different FICO scoring models, and the best way to handle collection accounts. And then we always like to end with an open Q&A. But throughout this webinar, I do want it to be a conversation. So if you have any questions, or if anything I'm mentioning doesn't make sense, needs more clarification, feel free to hop in. You can use the chat, or feel free to just unmute yourself, ask whatever questions you have. I want this to be interactive. I want to make sure you're really getting something out of having these Q&As. And so with that being said, let's go ahead and let me get into a little bit about who we are. So I own Insight Strategies Credit Repair. So we are an organization that helps people to improve their credit scores at a basic level. Our primary goal, or the primary clientele we tend to work with, are individuals that are trying to buy a home, whether it's their first home or whether they're trying to refinance their property. We know that a lot of loan officers and a lot of realtors have been burned by credit repair organizations in the past. One of the main reasons we like to put on these Q&A sessions is so you can take this information and you can utilize it in your day-to-day work. It's something that you can find some value from, and hopefully you can help your clients in particular situations where you may not need a credit repair organization. Alternatively, it also helps you know what types of things can be solved or what types of things can be fixed on the client's end, or when a professional needs to be involved. We also hope that it helps you build some trust in organizations like ours, where we are highly educated, we have a strong focus on the client, and we don't use any of those hardcore sales tactics that I think a lot of other credit repair organizations do use. So I'll share a little bit about my background. So I have been in the financial services industry for quite a while at this point, since 2007, going into 2008 and the 2007. So historically, I started in the industry working with individuals that had credit issues, primarily those hit hardest by the financial crisis, that had at least 2 mortgages with a loan to value of 125% or greater. Back at that time, my goal was to work with those clients in restructuring all of their debt. Most of these individuals had debt to income ratios of about 60 to 70% on average, and we're just trying to prevent foreclosure from things like a balloon HELOC, right? A home equity line of credit that either ballooned at the end or went into an amortized payment schedule that was just completely unaffordable. And this was, of course, at a time where nobody could refinance their properties, just due to the value. So from there, I moved into the regulatory side, working directly with the CFPB, because they were created back in 2010, and understanding how to implement those new policies and the new way that default had to be addressed and worked with on the consumer side with the big banks and the collection agencies. So that's just a little smidgen of me and my background. And why we started this credit repair company was primarily when I was focusing things on such a high level at the regulatory side, you're only able to help people so much. And I found myself, as I transitioned out of that, moving into financial planning, always going back to how I could help people get out of debt, how I could help people with credit. And organically, I just started shifting gears into focusing more and more on the credit and on the debt side of things. And here we are today with this organization now that's very much focused on helping people become financially literate, helping people understand credit, and really using credit as an asset on their balance sheet. So our goal is to help people with that first step, which tends to be that first financial goal of owning a home, and then building from there financially. So let's go ahead and get into it. So for our case study to make sense, I did want to go into what the credit repair process looks like. So that way you have a good understanding of when a client needs to come to this side of the spectrum to work on the process when it comes to rehabilitating a defaulted student loan, or if it's something they can do without needing credit repair, and then they can get to that end goal, purchase that home with you. So our typical process is typically we see all of our clients coming from a loan officer referral, or in some cases a realtor referral as well. We always do a free consultation where we're reviewing the credit report with that client, letting them know what's hurting them and then what's helping them and how we can further optimize what's working really well for them. Once they become a client, we provide them with an analysis, which is about a 10-page document that goes into a lot of detail in each section of their credit report, so they can understand exactly how to read a credit report and then have a more detailed understanding of what really is hurting and what really is helping, so they know why we're focusing on certain areas throughout the process. After that point, we begin working directly with the creditors, collection agencies, credit bureaus, and then, of course, in this case, specifically talking about the defaulted student loans, we're working with them directly on how they can rehabilitate their student loans. In some cases, this will be us coaching the client and directing the client exactly what steps they need to take to work on rehabilitating that student loan. In other cases, we connect them with a partner, which we'll talk about in a bit more detail here next. Our clients are also enrolled in a credit education course. This is going to be drastically overhauled, I'll call it, in the new year. So we are going to be launching a video education platform, which will start with helping clients on the credit building side, understanding credit, and then we'll flow into other areas of finance as well. Right now, they have one video series on secured credit cards, and then other educational emails just on different credit topics. The client's provided with credit building plan weekly emails as well. So this just gives them a more detailed understanding of the different steps or actions we're asking them to take. This could be anywhere from how to add rental payment history or utility bills to their credit report, what kind of accounts they need to open, or what types of things they need to be paying down. And then from there, or as part of the process, kind of synonymous with the other prior couple of items, we want to make sure the client's enrolled in a rehabilitation program for those student loans, or we start working on any pay for delete options, which just simply means if we uncover that a debt is valid, it does need to be paid, we'll work with that client in working directly with that creditor or collection agency and offering payment in exchange for that negative account to be removed to help see a positive increase on their credit score. From there, the client will also receive monthly score updates, and loan officers are included on any big score jumps. We want to make sure you're in the loop, you know what's going on as they are working on improving their process. And then our final step is the client buys the home. They may choose to continue the credit repair process during that journey and continue to refinance later. It depends on that client's goals and whether that client is just trying to purchase as quickly as possible or has the goal of getting their score up as high as possible. Any questions on our process at all before we get into the meat of today? Okay, all right, let's go ahead and jump right into it. So today I wanted to focus on a common question I have when working with loan officers, and that is student loans. How to handle when a client has a defaulted student loan. So defaulted student loans tend to create a lot of confusion, not only for clients, but just for any financial professional in general. It's not something we're really educated on how to handle. So with a defaulted student loan, it never goes away. So something that's important before I get into the specifics of this case study is when a person files for bankruptcy, student loans aren't a part of it. It's something that's not included in the bankruptcy. It's not a type of debt that ever expires, unlike other types of debt. Like if you didn't pay a credit card after so long, you can no longer, you'll no longer see it on your credit report, and you can no longer have any legal action taken against you for that debt. With a defaulted student loan, it just lingers forever. It'll follow you until you take some sort of an action to resolve it. In some cases, what will happen is your federal income taxes, if you're going to get a tax return, they'll seize that tax return to pay for the student loans. They may place a lien. I mean, there's all sorts of actions they can take, but they're going to get their money at some point. So these are a type of debt that just definitely can't be ignored and need to be handled. So we can't ignore them, but there are definitely solutions when it comes to the defaulted student loans. So the primary option that most clients we work with will take is going through a rehabilitation program. So all federal student loans have the option to go through what they actually call the loan rehabilitation. So loan rehabilitation, the basis of what happens is you have two options. One, you can pay the full defaulted balance, like the past due payment amount that they determine this set amount of money will accept, and then your loans are no longer in default. In many cases, just depending on how long they've gone into default, that could be the entire student loan. It really depends on how long they've let it sit there. Some may find that affordable and they'll go ahead and do that. Then what would happen from there is they'd remove that loan from default status, and now you'd be able to pass K-verse, right? You'd no longer have that issue if you're trying to qualify that borrower for, let's say, like a VA loan, for example. In other situations, what will happen is that client will be set up with a repayment plan. So that repayment plan can be anywhere from a couple months to a year, whatever is deemed as financially appropriate. So they'll look at things like that individual's income if they are saying they're having a hard time to afford the student loans. And the way this is going to show on a credit report, and let's look at a credit report real quick for a defaulted student loan. I'm going to go ahead and share my screen for a credit report so you can see that. And everything here has been redacted, so there's no private information that's going to be shared. Okay, so let's go ahead and take a look here. All right, so on your screen, you should see a credit report. It'll look a bit different than the reports you're used to seeing on the mortgage side of things. So when an account is defaulted with the for the federal student loans, excuse me, it will look very similar to this. So this one in here, you'll see transferred to another lender. Let me get to, here we go. That's just a name. Okay, so here was the original servicer. So the original servicer of the student loans, you'll see this loan listed as a collection account. You'll see right here that the account will show closed and open here. It gets very confusing, doesn't make a lot of sense. There's a balance, seriously past due, collection account. So this is how we know that it's defaulted. Sometimes it will say default. It's a little different on each credit report. It depends how old it was, who the original servicer was, where it's been moved to. Sometimes they'll sell a new servicer, but it'll still be a defaulted loan. So this is what it looks like before rehabilitation begins. You see the balance owed, and you see all this derogatory information. So when a person starts to work on that rehabilitation process, if they are given a repayment plan, the account status will still look exactly just like this. Every month, if they get a new credit report, every month you pull a new credit report, it's still going to look just like this. Balance might change a bit, of course, because they're making payments towards it, but the actual account status is going to remain exactly the same, still in default. You're still not going to be able to pass CAVers because it has not been rehabilitated. So at the end of that repayment term that has been outlined by whatever they've agreed, the account will change, right? The account will then become rehabilitated. And what will happen at that point is a brand new account will be created. So in this case, if this person chose to keep making monthly payments, all of these accounts would be consolidated into one new account, and they would start fresh. Now, these were just delinquent ones, so these are a little bit different. But they would just start fresh with one brand new student loan that would be opened. Let's say they finished their payment plan in January of 2022. So it would have an open date of January 2022 right here, their new balance, and then they'd have monthly payments that had been determined. And you'd start seeing the on-time payments starting at January 2022. So it would look like for all intents and purposes, a brand new loan on their account. Any questions about that so far? Okay. So from there, what would happen, and let me just get this pulled up. So from there, what would happen is the old accounts that existed on their credit report would be updated to, they no longer say default, they no longer say collection or anything of that sort. That would all be removed from the credit report. What would still exist is the late payment history. So the account would essentially just show closed, and it would show late payment history up until the time that that account actually went into that default status. And default is essentially just more of an accounting term. It really just means that they're counting it now as a loss. They're just giving up on that person making payment and calling it a collection at that point. So the important thing is that they would be able to pass CAVers at that point. They also would receive a letter in the mail. So if you ever needed proof or you ever needed to give something to underwriting to say that they did go through rehabilitation, they do get a letter that says that their loans are rehabilitated with all of the account numbers associated with the rehabilitation. What confuses many of the, oh, it looks like we have a question in chat. Nope, I'm not sure what the nope's for. Feel free to expand on that a little bit. Oh, okay, thanks. So what I lost my place here, my train of thought. Oh, what the letter will also say that confuses many clients or many people that do get that letter is it says that the default status has been removed from your credit. And I think I have an example here. Let me pull up my example so I can show you exactly what this looks like. So if you see this from a client, you know. Okay, bear with me here. Here we go. Got to pull up the redacted version. Okay, here we go. So let me share this. So they get a letter that looks exactly like this. Woo, let me zoom out. All right, so they'll receive the letter. They'll say, congratulations, you've successfully rehabilitated your federally held student loans that were in default. They'll list all the loan numbers as you see here, and then the type of loan, direct, Pell, whatever type of loan they had. And then what really confuses people is this part. Removed record of default from credit history. So many clients will incorrectly assume that that means the accounts are all going to be deleted from their credit report, and they're no longer going to have their credit score impacted because that has been corrected. So that's not the case. So I just want you to be aware of it. It won't be deleted. What will happen is just the default status is removed and the late payment history still shows. But again, they'll start off with a new positive loan that's going to start helping their credit score. It's going to start reporting positive information on their credit report. Okay. Any questions about any of that before I go into a specific client example? All right, we're good. So let me go back to sharing my screen here for the PowerPoint and from current slides. Okay, so let's start off with a specific client case study that we had. So we had a client came to us in January of 2021, end of January 2021, with credit scores originally starting at 514, 518, 473. Referred to us over from another fellow loan officer partner. She had two different sets of defaulted student loans. Really what that means is she had two loans released at different times. So you may notice on client credit reports, they'll have like 5 student loans with the exact same account number. I like to think of those as you have a parent loan where multiple tiny loans are released under it, right? So as that person went through different terms or different semesters, loans were funded, and each loan is at a different interest rate just based on what rates were at that time. That's why you see so many loans with the same account number. So she had taken out 2 different parent loans, if you will, that had multiple children loans under them. So 2 sets of loans. Hopefully that makes sense. She had a history of federal taxes being seized for the defaulted loans. And her credit report still showed balances on these defaulted loans. So it took us quite some time to gather what loans were satisfied by taxes, because by the seizure of her taxes, if you will, simply because taxes were garnished over multiple years, and she wasn't given information on what loans were satisfied by those taxes. So finally, it took us all the way till July 2021 to get that part straightened out, especially because of COVID. It caused a lot of delays in getting information from not only the IRS, but the student loan companies. So finally, in July 2021, we connected her with one of our partners called Student Loan Survivors. We like to connect all of our clients with student loan survivors when it makes sense, because what they do is they will analyze the student loans to see if that individual has the ability to have any of their loans forgiven, and to make sure they're also able to go through the history of the loan and look at things like the taxes, make sure that the information that was supplied is accurately representing what occurred. So sometimes they find errors in the books. Who would have thought that the government didn't keep completely accurate records. But beyond that, they are the experts at filling out the documentation. Student loan servicers are notorious for not approving someone for a forgiveness program simply for a very minute error on documents. And they won't tell them why. They'll just tell them they didn't qualify. Thank you for trying. So we want to make sure when we're in these situations where we have the ability to save our clients tons and tons of money, we're doing so. So in this case, we found out that she did qualify for a little known repayment program. And a lot of that's based on sometimes career, sometimes just when you took out the student loans, what types of student loans they are. So we do want to make sure we get everyone qualified there. So let's see. So let's talk about what happened with the scores over time. So this is what had happened with the student loans. Consolidated the loans to the rehab program. She had a repayment period they had established, and at the conclusion of the repayment period, she was enrolled into the repay forgiveness program. So that's what it's called. So for a set time, she pays the loans. At the end of that set time, the whole balance that's left is then forgiven. So at the time she started the credit repair process, so again, this was back in January 2021, she had 0 open accounts. So all she had on her credit report was closed accounts, with almost all of the accounts being negative, 2 positive accounts. So she had 13 derogatory TransUnion accounts 9 derogatory Experian accounts, and 13 derogatory Equifax accounts. She was provided with 6 credit building tasks to add positive history to her credit report. So as a reminder, the credit building tasks are a series of actions we recommend that client takes in order to build positive history on the report, but to, of course, improve their credit score. We want to make sure they look credit worthy so they can get approved for lending. At the end of our journey, so where we are right now, she's still a client with us, but where we are at this point as of November, the client only has 4 derogatory TransUnion accounts left, 0 derogatory Experian accounts, and 0 derogatory Equifax accounts. So let's look at that on her credit report. So she's the example that we saw earlier. And now let's look at what we have going on here. All right, we flipped screens here. So because we were able to go through the rehabilitation program and we were able to close those defaulted student loans, we were able to successfully remove almost every one of those student loans from her credit report. Now they're closed accounts, so it makes our jobs a bit easier. And I'm not going to go into the nitty-gritty details of how we do that, because that in and of itself is a whole long conversation. I'm definitely happy to have that conversation. If you want to go into it, just let me know. But as you see from where we had started, let's go back there. We had, here's the top. We had several derogatory accounts showing on this credit report, right? A lot of things that we needed to work on getting removed. Mostly all student loans. So at the time where we are now, we have just the student loans showing up on TransUnion. And there's 4, if I counted right. Yep, 4 here on TransUnion. And then here is what you see with the brand new rehabilitated student loan. So we've got a new balance. You can see we've got the payments that have been started, creating good positive payment history on the credit report. So it looks completely different. It looks like a brand new account started in August after she finished her payment plan. And she chose the option of just a lump sum to catch things up rather than doing several months, which is why it started so soon after we started the rehab process in July. So it can be quick. That's the okay. Can everyone hear me? My screen just disappeared and came back. Okay, cool. All right, let me share my, I dropped the, there we go. Okay. So let's go back to this. It closed out on me, so apologies there. Okay, so again, this is the new positive account, building positive history. And then she was able to do some other credit building, as we see on here, some of our other recommendations, adding positive accounts to her report. So that's what her report looks like now. And then I'm going to go back to the, I know lots of back and forth. Hopefully I'm not making anyone sick here. And we'll go ahead and we'll go right back to our presentation. All right, so what does all of this result in? What does the rehabilitation result in and the credit building result in? What can happen from that? So client opened 3 new accounts from our 6 actions that we told her to take. She completed a total of 4 of the 6 credit rebuilding steps, so she hasn't quite done all the steps yet, but she still was able to see a significant jump in her credit scores. So now she's at the point of scores of 708, 661, and 659. And that's coming from the 514, 518, and 473 that she started at. So in most cases, about a 200 point to 150 point increase in her credit scores. So, you know, when we really focus on what is possible and we give our clients hope that they can come out of whatever's happened, whatever caused them to go past due in the first place. And when they see the results like this, it just gives them renewed hope, renewed reassurance that they can buy a property. You know, a lot of times they get that initial, you know, you're not quite there yet, and it can it can hurt. But when we go through the options that are available to them, we give them hope that they can do something and they can come out of it. So a lot of times people just feel like, gosh, this was so long ago. It's been following me around for years. And they just lose the desire in some cases to try to do something because they've just been smacked down so many times. So our goal is to help them realize that it is possible. So we talked about that client and her successes. I'll go into one other client, and this one's super brief. So we have another client who had $900,000 in student loans. Huge amount, right? More than, sometimes that's two people's mortgages. And for her, she just felt buried, just absolutely buried under these student loans. In her case, this isn't a situation where her student loans were defaulted. So just know we don't have to just work with defaulted student loans. She just had an affordability issue. And when you're coming to the table with $900,000 in student loans, it's extremely hard to qualify for a mortgage, as I'm sure you all know. So in her case, what we did is we were able to find out that she did qualify for a forgiveness program. So what that means for her was that after 10 years, whatever the balance that is left will be forgiven. So we're able to get her set up with minimal payments, the smallest amount of payments that were possible for her student loans. And then in 10 years, she would owe nothing else. So even if she only paid off, let's say 100,000, even if it was 100,000, that sounds like a ton. It is a ton, but that would be $800,000 that would be forgiven for her. So there's a lot we can do on student loans, and a lot that's possible that just isn't common knowledge and people just aren't aware of. So that's all I have for the planned remarks. Lots and lots of information today, but I'm curious, with all of this new information, has it sparked any questions for anyone? Any situations you have come across similar to this? No questions. Okay. Does anyone have any other questions related to credit at all? Because again, this is an open Q&A, so we're happy to always chat about any other topics. It doesn't have to be just specified to our prepared case study or prepared remarks for the day. Okay, well, I will take this opportunity then to chat about one of the other time permitting topics. So as far as one of the other time permitting topics that we had prepared, it's how do I help borrowers understand the different FICO scoring models? Really, that's just a fancy way to say, who is sick of hearing clients tell them that their Credit Karma score is the score they're going to see when they get a mortgage? We now have a lot of prepared material around this. If this is something you're finding is difficult to address or you're not quite sure how to have that conversation, we can help. So we have written materials that you can provide to borrowers. You can lead them directly to. We also, coming in January, are going to have educational videos that will be released directly to that. So it can be something that you forward out to your prospective borrowers. And our goal really is just to educate the borrowers on that. And I'll ask, does anyone want to hear the difference between Credit Karma and the Credit Karma scoring and FICO scoring? Is that something that anyone's curious about? Okay, great. I'll be happy to go into that. So Credit Karma is what's called the Vantage score, and most of the free services that most people are using to get their credit score. So you've got Credit Sesame, Credit Karma. They're the main ones that I hear, but there's a ton of them out there. They use a score called Vantage score, which was created in roughly, I want to say it was like 2006-ish, maybe it was 2009. somewhere in the mid 2000s. And the goal with the creation of that was really 100% marketing. So a little bit more of a background is credit bureaus don't work for the consumer. They have contempt for the consumer. They have contempt for anyone coming to them and saying whatever they're doing is wrong. They work for all of the financial companies that use them. That's who pay them, and that's who they want to make happy. So when a company can find another way to provide a product that's going to make them money, they do it. And so what they did is they created the Vantage scoring system, which is basically a giant marketing platform. So the first iteration, Credit Karma. So Credit Karma, essentially, the way it works is if I am company A and I want to sell a bunch of secured credit cards, or I want to sell a bunch of personal loans, I'm going to pay Credit Karma so I can access that customer data. And how is Credit Karma going to get the most amount of customer data so they can feed it to these financial institutions in order to know who's going to be the best person to qualify? Well, they give it away for free. If we're getting something for free, why wouldn't we participate in it? Seems like a great deal, right? I get all this information for free. I've always had to pay for it. Of course, I'm going to sign up. So people sign up thinking it's their credit score. They get the information on their credit report. So why would they know any different, right? Why would they think that score is anything but real? And then in turn, the Credit Karma, or any insert company name here, sells that to whatever financial institution is paying them for that data, and then they can do targeted marketing, to that consumer. So that person with Credit Karma might start getting offers for a credit card that says, oh, you're pre-qualified. Credit Karma will send it to them directly, or they'll get it in the mail, email, whatever, right? So Credit Karma is a completely different algorithm. It ignores things like, let's say, I'll give you a great example. Paid collection. A paid collection has absolutely no bearing on credit score in a Vantage score model. It's completely different in the FICO scoring model. Completely different. It doesn't matter if a collection is paid, it still damages that person's credit score. And in that Vantage model, it encourages a person to pay that collection account, which can actually hurt their FICO score even more, or they can end up paying a debt they don't owe because unfortunately, the collection world is still the wild, wild west, barely regulated, and there's a lot of shady stuff going on there. So that's my long spiel about Credit Karma and FICO. But then to go into it in even more depth, let me share my screen here. Let's say you have a person who says, well, it is my FICO score. I know what my FICO score is. I looked up my FICO score on Experian. And then you pull their credit for the mortgage and we see, oh my goodness, it's still different. Well, if a person was to go to Experian for free and it tells them it's their FICO score, it is. It's totally their FICO score. But it's their FICO 8 score. So really, what do I mean? I'm going to break this down now. So FICO has come out with many, many different iterations of the credit score. So it's just different algorithms, different ways to calculate the information. All the information is based off of the same details, if you will: payment history, utilization, length of credit, so average age of account, how much accounts are new credit and inquiries, and then what type of credit use, so installment versus revolving debt. But the way it looks at that information is altered with each new iteration of FICO. So as these new versions of FICO come out, because that calculation is different, it causes a difference in score. So Experian FICO 8, a lot of people will pull it. They might get their FICO 8 from Equifax and TransUnion too. When you're pulling a mortgage, you're not pulling those scores as you see down here. You're pulling older versions of FICO. Why that is so very important is because of the way negative information is viewed on the newer versions of FICO versus the older. These older versions of FICO are much, much harder on negative information, specifically things like late marks. It's time weighted in newer versions of FICO. So the older the late payment, the less impactful it is. on some of the older versions of FICO, more specifically FICO version 2, it's not time weighted. We don't see that same emphasis on it not mattering, or we don't, let's say that a better way. We don't see so much of an emphasis on, because that late history was so much further back, it has less of an impact. So really it's pretty straightforward. More negative information, low score. More positive information, higher score. So for someone to get their FICO 8 score and it be, 50 points different or more, it's not unusual, because again, things are time weighted here. Medical collections that are paid, for instance, on the newest version, FICO 9, which we don't really see widely used yet, medical collections aren't factored in at all in FICO 9, definitely factored on the older versions in mortgage lending. So a person can go get an auto loan and they don't know what score is going to be used, right? We have industry specific versions too. So this auto lending version is looking at what's the likelihood this person's going to go delinquent on an auto loan. It doesn't care about their credit card history. It's looking at installment debt, how installment debt's been paid in the past, so they could have a super high auto credit score as compared to a credit card, or vice versa. They've got great credit card history, but they've had a repossession. So maybe their FICO score and credit card decisioning is higher. Still going to be different than mortgage. So again, everything's meant to be convoluted. It's meant to be difficult for the consumer to understand. And in turn, we're all consumers, whether we're financial professionals or not, we're still all consumers. And it's just confusing for all of us. So even though you are in mortgage lending, you are in the real estate world, either or, it's not fair to expect you to know everything about credit scoring and how it works. So feel free to use us here as a resource. If something doesn't make sense when you're looking at a credit report, you pull a credit report and you're like, what the heck is going on here? We're happy to always help and look out. So that was my long-winded explanation of FICO and Vantage. And so again, we do have some educational material we can provide that you're welcome to forward on to people for that. And then coming in early new year, we'll have some videos on it too. Any other questions? Okay. Well, then we can go ahead and end this session. Again, we will be doing these Q&As repeatedly. So we're going to take a break for the holidays, of course. The next one's going to be January 10th. So I will definitely make sure that I reach out to everyone, send you that information for January 10th, what the topic is in January. And then you can always feel free to submit questions ahead of time, and we will discuss those on each webinar. But again, January 10th.